guys. I wanted to have a bit of a fun experiment on this video around kind of generating a kind of returns from a 500k portfolio. I thought it'd be just a bit for entertainment purposes. So just to kind of remind people around the cover call strategy. So this is where you own a stock and sell the right for somebody else to buy it from you at a set price. In return, you obviously get paid the premium, and you've got to own 100 shares to be able to write one contract, and then obviously you collect the premium at the end of it. All right, so I'm going to model a 500k portfolio. I've assumed converting that into dollars, about $625k dollars, so 1.25 is the exchange rate. And what's interesting is I've kind of modeled out three positions. So you've got a conservative one with JP Morgan with an implied volatility around about 25%, and that's at 208k, and that's 7 contracts. I've then got a balanced one with Apple, which has got a slightly increased volatility around 35%. Again, allocation around 208k, but that translates to 9 contracts. And then I've gone for an aggressive one with Nvidia at 55%. Now, I know there's more aggressive than Nvidia, but I just wanted to try and pick a sensible balance across the three. And again, that's at 1,307 shares, so 13 contracts. Now, in terms of the actual levels of the changes that I could make within the portfolio, I've got 3 things that I can look at. The stock choice, which drives the volatility, which we've looked at above. The timing, i.e. whether I can sell weekly, monthly calls. Obviously, you could change that to any time period, really. But weekly and monthly are the most common nowadays. And then the actual strike price. Okay, so if we look at each one individually, obviously the stock choice, the higher volatility ones will typically command higher option premiums, and they will boost my income. But we'll talk about the trade-offs of that one later on. Timing, again, selling weekly options can generate higher returns than monthlies due to that time decay, which again we'll talk about in a second. But again, there are trade-offs there. And then the ambition, which is the often referred to as the delta, which is the trade-off between the income and the risk of your shares being sold or taken away from you. And the best way to think about delta is you've got low delta, which is like 0.2, which is lower income, but there's a 20% chance of a sale occurring. Okay. A mid delta is higher income, but there's a 50% chance of you having to sell your stock. And then there's a high delta where you've got the highest amount of income, but you've got the greatest risk of around 80% chance of your stock being called away. Now, in terms of the income scenarios and the trade-off between the safety and the yield, obviously the income you can generate is not a single number. It's a range based on how comfortable your risk tolerances are. Obviously, selling closer to the stock price, i.e. more aggressive, yields more, but the chance of you having to sell your shares are far greater. So I just wanted to kind of visualize, just to give people an idea based on the same stock, what kind of different percentages could lead to. So if we look at a low volatility stock like JP Morgan at 25%, if you're far out the money, then the chances you could set a 15%. Now, if you're slightly more balanced, then you might want to go 22%. And then if you're going to go aggressive, it could be 28%. But again, if we look at Apple as a flip reverse, where it's kind of more mid volatility, then far out the money could be 30%, a balanced could be around 50%, and an aggressive at 72%. Okay. Nvidia is probably the most interesting of them all because it's so high vol. Even going conservative, you're still going to get 50%. A balanced could get you 80%, and an aggressive could get you to 105. Now, obviously, what you've got to realize is these may not be consistent, right? And this is the important thing, because it's range-based and it could depend on what the markets do. But I think it gives you a flavor of, in each of the categories, conservative, balanced, and aggressive, the fact that due to the volatility being different, you can get a lot more premium to be a little bit safer for the higher vol ones. But there is that whipsawing and the upside, which we'll talk about a little bit later on. Okay. Now, in terms of the sort of the benchmarking, in terms of ETFs, I just wanted to kind of talk about single stock versus a basket of stocks within them. Now, there's a plethora of these out there. I picked some that have just been around for a long time because the newer ones, they haven't really been truly tested yet. But you can kind of see how, if I went really aggressive with Apple, I could do 70% on the weeklies. With JP Morgan, even if I went aggressive, I'm still sort of capped from a monthly structure perspective around 16% or moderate. If I went with QYLD, it's net. Now, this is net annualized return. I should have kind of mentioned that these are not gross, these are the net annualized returns. QYLD is around 7%. Obviously, gross is closer to about 12. And then XYLD, which is on the S&P 500, is 6%. So we can actually see how we can eke out a lot of extra premium and income from a single stock because you're taking all of that single stock risk and the volatility behind that. Whereas when it's a basket of stocks, it's kind of blended and that risk is blended. So it's obviously a bit more safety in that, but obviously you get typically less premiums from that mix. Now, the other element I talked about was this time decay element. So the thing that you can change your time horizon. And I just wanted to kind of, and I've covered this in the Greeks video, but again, just as a reminder for those of you that may not have watched that, an option's value decays faster as you get nearer expiration. So the theta decay of selling a weekly option can generate higher income because it's got a higher level of decay. And obviously time in the markets is really, really important. A lot can happen in 30 days, whereas a lot of movement can happen in a week. And we've seen that when Trump made the announcements of the tariffs, everything tanked overnight and we saw this massive drop, and then it took a while to recover. If I bought the monthly, I would have been able to have that time for the news to have settled in the markets, for negotiations to have taken place. Whereas if I bought the weekly, chances are I would have blown through my strike price and I might have had to get rid of my shares. So there are things that you just need to be mindful of with the time element of it. Okay, again, just to kind of talk about the three primary Greeks here. So you've got the delta, which measures the option's sensitivity to the stock price. It's probably the one I look at the most because it's kind of a proxy for the probability of the option expiring in the money or basically being called away in effect. Using a delta to pick strike price is kind of your best way of managing risk. So the best way to think of it is a 0.3 delta call has a 30% chance of assignment. Okay. Theta is another important one. It kind of measures the rate of time decay. So it's the amount of value an option loses each day. And that, as we've seen in that chart above, accelerates closer to expiry. So takeaway as a seller is theta is your best friend. So time decay erodes the value of the option that you've sold. Okay. And then the very final one, which we haven't really talked about yet, but it's gamma, which measures the rate of change of delta. So it's the highest for the at the money option near expiry, making them highly sensitive to smaller price movement. So the takeaway here again is beware of gamma risk on weeklies. A safe position on Wednesday could be more risky by Friday. So again, a high gamma, I'd probably avoid it for doing a weekly odd. Probably okay for a monthly, but I would, if I was doing it personally, I'd probably avoid the weekly on those. So again, the three core ones there: delta, your chance of assignment; theta, the time decay element; and then gamma, kind of the movements between them. And again, if you haven't watched my Greeks video, I go into a bit more detail on each of these. But again, it's just kind of a bit of a summary and reminder, maybe for those that haven't seen that. Again, another thing to obviously think about is that you are capped with option strategy. So you are giving that upside. a buy and hold, which is kind of represented by this grey line going up. Now, obviously, this is theoretical. Stock price never goes up linear, but it's just to kind of give you that view of the potential loss that you could be taking. I call it a loss because you could have potentially earned that. Now, is it an unrealized, realized loss? You can debate that conversation. But the idea here is just to kind of visualize and represent the fact that when you have a stock price and you set a strike price, let's say at 105, and your premium is 2, then you're capped at that 107, basically. So if it goes over 107, you're not going to capture any of that. And again, this is just to kind of represent that in a bit of a visualization. Okay, what is your primary goal for the stock and the strategy? So if I want to hold it forever and just add a little bit of income, right, then I might sell monthlies, far out the money, low delta, gives me that little bit of juice for holding the stock, but I don't, I still believe in the companies. I still want to hold them for the long term. Option number 2 is I want to maximize my income, and I'm happy to sell the stock if the price is right. I've got this price in mind, and if it gets called away, I'm okay with it. And that's where you might be willing to sell a weekly call, but, at the money and have a really high delta. All right. But there could be a balanced approach where I like the stock, but I want to generate some decent income from it. And I'd sell on it if it was on a real strong run, because I just want to capture that. All right. And this is where I might be willing to sell weeklies and monthlies slightly out of the money and a bit more of a mid delta. And so this is kind of the balancing act that you've got to do with options trading. Is you've got to have in your mind which of these 3 primary objectives are you trying to achieve, right, when you write a covered call. Obviously, this is a 2-sided coin. So when we looked at that 500k portfolio, right, imagine if the stock price rose within that portfolio by 20%. If we were to just simply buy and hold, we'll have captured 38.5k, right? But with our covered call strategy, we're only going to get about 4k. So we're leaving that remaining money on the table. And this is the opportunity cost, right, of running this strategy. Now, if we look at the downside, however, there is a kind of benefit here where if my portfolio dropped by 38.5k, if the stock was to drop 20%, my cover call would lose slightly less than that at 35.5k. So there is some downside protection because I'm getting that income, okay? And that's offsetting some of that downside risk. So there you go, guys. Hopefully that gives you a really nice flavor. It was a bit of a fun experiment, but I think it was nice to see a real world along with a bit of conversation about the different strategies and approaches that you can take. So hopefully you enjoyed that. Write in the comments whether you enjoyed that. Which of the 3 strategies that we talked about here would you primary target as an income investor? Are you on the low delta side, high delta side, or the mid delta side? All right, guys, I'll catch you on the next one.